Wow, this earnings report from Aarti Industries is quite a lot to unpack. Where do we even start?
Well, I think a good place to begin is with the company overview, what exactly they do and how they fit into the market. It's like understanding the recipe before tasting the dish.
Okay, so Aarti Industries is a global specialty chemical company, right? They're like a major player, apparently ranking first to fourth in 75% of their portfolio. That's actually pretty impressive, I'd say.
Exactly. They combine like process chemistry with, scale up engineering. It's like they're not just making chemicals in a lab, they're doing it on an industrial level.
Got it. And it looks like they're really pushing sustainability and innovation too. They mention integrating environmental stewardship into their business model, which is nice to see.
Right. And that's definitely a key point. They're saying they want to balance economic growth with ecological responsibility. It's like trying to have your cake and eat it too, but in a responsible way.
Okay, so moving on to the financial performance, let's start with the income statement. I see that their quarterly revenues are up 14% compared to last quarter. That's a pretty solid jump, isn't it?
Yeah, it's definitely a positive sign. The income from operations went up to 2035 crore rupees from 1786 crore rupees. So it's like their business is expanding and they're actually making more sales.
But their net profit or PAT is down 12% compared to the previous quarter. What's going on there?
Well, that's where things get a bit tricky, you see. It looks like a mark-to-market loss on a long-term loan due to the rupee depreciation impacted their profit, about 23 crore rupees loss.
So that's like when currency exchange rates mess with your debt. So even though they sold more, they had some external factors pushing down the profit.
Exactly. It's like trying to run a race with a strong headwind. You might be moving forward, but it's harder than usual.
All right, let's look at the 9-month financials. It seems their revenue is up 15% compared to last year, and their EBITDA grew by 7%.
Yeah, the 9-month numbers paint a generally positive picture, I think. Revenue at 5,833 crore rupees versus 5,057 crore rupees is a good leap. It shows a clear growth trend.
So, despite some quarterly hiccups, the overall trend seems to be growth oriented. Now, how do they manage their cash flow though? Is it enough for future projects?
Well, the cash flow statement isn't provided in detail here, but we can see they are investing in capacity expansion and renewable energy projects. It's like they are reinvesting their earnings for growth, which is good for the long term.
Yeah, they seem to be putting money back into the company. They are doing a lot of expansion, especially with those nitrotoluene and ethylation projects. That sounds like they are setting themselves up for more growth.
Yes, and they're also making big moves towards renewable energy, aiming for 75% renewable power by Q1 FY27, which will lead to significant cost savings down the line. It's like planting a tree, it takes time, but eventually it bears fruit.
Okay, so they're investing in both capacity and sustainability, which, sounds like a smart move. Let's talk about the key financial ratios. I know that can be like super helpful.
Absolutely. Ratios help us understand the story behind the numbers. It's like using a magnifying glass to see the details. For instance, we can analyze their profitability, liquidity, and debt ratios.
Okay, so their operating margin is around 11 to 12%, which seems stable. What does that mean in plain English?
It means that for every 100 rupees in revenue, they're making 11 to 12 rupees in profit before interest and taxes. It's like a restaurant making that much on each dish after the cost of ingredients.
Got it. What about their net profit margin? It's around 2 to 4%, a bit lower, right?
Yeah, it's lower than the operating margin as it includes the impact of interest and taxes. So the net profit shows how much they are actually keeping after all costs.
Okay, that makes sense. Now, what about the debt ratios? I saw the net debt equity ratio is around 0.7. Is that risky?
Well, it means they have about 70% debt for every 100% equity. It's not alarmingly high, but they are using debt, which means that, they need to manage it carefully.
Right, that makes sense. And their current ratio is below 1, which might, raise some questions about their liquidity.
Yeah, the current ratio being below 1 suggests they might face some short-term liquidity challenges as current liabilities are more than current assets. It's like a household having more bills than cash in hand, they'll need to manage it well.
So they have some things to keep an eye on, but overall they are showing growth in sales and expansion. They even got some awards and recognitions for their practices.
Absolutely, they are growing and they are being recognized for their operational and employee experience, which shows positive things too. That's also important to keep in mind.
So based on all of this, what's your overall take? What do you think the future looks like for Aarti Industries?
Well, they've shown some resilience with the volume growth driving their earnings, and their strategic investments in renewable energy and capacity expansion is encouraging, right? But they do need to manage their margins, liquidity, and debt carefully.
Yeah, I agree. They need to handle those cost pressures and keep an eye on that debt for sure. But I think, the company's expansion into new markets like the US, Europe, and Japan is really promising.
Exactly. And their commitment to sustainability is also going to be something important in the coming future. It's like they're positioning themselves to ride future trends.
So overall, it's a mixed bag with some very positive signs and a few areas to watch closely. It's not a clear-cut story of all sunshine, but it's definitely a company with growth potential, I guess.
I think you're spot on there. It's a company with some strong growth drivers, but like any investment, there are things to consider. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Right, and that's a good point. Investing involves risks. So, everyone should really do their homework and not just rely on like random podcast analyses.
Absolutely. I mean, we are just breaking down the information, but the real work is up to the listeners to make their own decisions.
So, to wrap it all up, Aarti Industries is a major player in specialty chemicals, is showing solid revenue growth. They are, dealing with some cost pressures and debt issues, but they are moving forward with big projects.
Yeah, it's a company that's both growing and evolving. They are taking steps for the future, but they still need to handle those short-term challenges.
Well, this has been a pretty insightful look into their earnings report. It's like we've taken apart a clock to see how it ticks, right? It was fun.
Exactly. You've uncovered a lot of layers. It's important to always dig into the details when analyzing a company. And hey, if you've enjoyed this analysis, please like, share, and subscribe to our YouTube channel for more content like this.
Absolutely. Well, until next time, remember to keep those financial brains churning and, do your due diligence on these numbers.
Agreed. And as always, stay curious and keep learning. So, what are your thoughts on this report? Let us know in the comments below.